We all seek a quiet harbor in the storm of the markets, don't we? A place where the winds of uncertainty cease and the promise of growth feels guaranteed. Many voices whisper promises of quick riches, of secret algorithms, of the next hot tip that will finally secure your future. They speak of external forces, of market timing, of knowing what asterisk to buy. But deep down, a quiet ache persists, a fear of financial loss, a gnawing inadequacy that tells us we might miss it, that we might fall short. This fear, this longing for an external guarantee, often blinds us to the true source of enduring wealth. Consider the profound wisdom of Benjamin Graham, the very architect of value investing, who once observed the investor's chief problem, and even his worst enemy, is likely to be himself. This isn't just an observation from a bygone era. It's a mirror reflecting a timeless truth. It asks us to look inward, to acknowledge that the greatest obstacles, and indeed the greatest opportunities, reside not in the volatile currents of the market, but within the intricate landscape of our own minds. Perhaps the word guarantee itself has been misunderstood, twisted into a mirage of effortless gains. True success in investing isn't about sidestepping every wave. It's about building a vessel that can weather any storm. It's about a guarantee of process, guarantee of a robust framework that preserves capital, cultivates growth, and fosters resilience over the long arc of time, regardless of what the headlines scream. This isn't about avoiding risk entirely, but understanding it, shaping it, and ultimately mastering your response to it. If this is true, if the enemy and the ally both reside within, then what hidden cognitive biases, what unspoken fears, what lingering doubts are preventing you from mastering this one essential skill? What if the path to financial mastery isn't found in chasing external signals, but in cultivating an unwavering inner discipline? We're uncovering the hidden truths behind wealth accumulation, challenging the consensus to help you find your edge. Don't just invest, understand the why behind every decision. A quiet unease often settles within us when we sift through the endless stream of financial news. A silent distrust of financial authority, born from past disappointments or conflicting advice, can lead to a paralyzing analysis. We are fed narratives designed not to enlighten, but to engage, to capture our fleeting attention with urgency and drama. But what if these very narratives are subtly obscuring the genuine underlying mechanisms, the hidden truths of complex financial markets, rather than revealing them? This constant influx of information can trick us into what appears to be conviction, but is, in fact, a deeply ingrained confirmation bias. We selectively absorb data that affirms our existing beliefs, inadvertently building a fortress around our preconceptions, leaving us vulnerable to inadequate due diligence. Think of historic market bubbles, where the chorus of consensus grew louder and louder, drowning out the quiet, data-driven whispers of impending reality. Many clung to the comforting story, even as the numbers painted a different, harsher picture. To move beyond these superficial headlines, we must cultivate an analytical skeptic's lens, a three-step technique rooted in the fundamental principles of strategic finance. First, isolate the raw data, stripping away all interpretive commentary. Second, examine historical context, asking how similar situations unfolded and what underlying principles were at play. Third, connect these insights to first principles of value, asking, what is the intrinsic worth here, independent of market sentiment? This process allows us to deconstruct market narratives, transforming noise into strategic signals. The cognitive and emotional factor that often sabotages our ability to critically analyze financial data is a powerful, unconscious need for certainty, for a clear and ambiguous path. But true clarity often emerges from embracing uncertainty, much like a forensic accountant meticulously sifting through ledgers, questioning every entry rather than accepting them at face value. This skeptical mindset, this disciplined questioning, is the bedrock of informed decision-making. Consider the path of George Soros and his reflexivity theory, which illuminated how market perceptions can influence fundamentals, creating feedback loops that defy conventional logic. Soros didn't just react to the market, he understood how the market reacted to itself, and how prevailing narratives could be fundamentally flawed. His approach underscores the critical importance of independent thought and data-driven analysis over market sentiment. He challenged the consensus, and in doing so, found his edge, uncovering asymmetric opportunities where others saw only risk or accepted wisdom. The market's ceaseless rhythm often plays upon our deepest vulnerabilities, triggering a primal fear of financial loss. This isn't merely a logical concern, it's a visceral response, flooding our systems with cortisol, driving us towards impulsive, emotional reactions that hinder empowered, data-driven decision-making. The very neurochemicals that promise reward, like dopamine from a sudden gain, can also lead us astray, making us chase fleeting highs rather than enduring value. One of the most insidious traps is loss aversion, which often disguises itself as prudence. We cling to losing positions, not out of sound analysis, but from a profound philosophical wound, a reluctance to admit defeat, to realize the loss, even as our capital steadily erodes. This isn't intelligence intelligent investing. It's a battle against our own psychological wiring, a resistance to the cold, hard truth of the numbers. The pain of acknowledging a mistake can feel sharper than the slower, quieter pain of continued decline, leading to decisions that defy logic. To navigate this inner landscape, we can adopt a symbolic exercise, create a personal decision journal. This isn't just a ledger of trades, it's a space to dissect, unpack, and reveal the *Y* behind each choice. Document your initial hypothesis, the data points considered, your emotional state, and the outcome. This practice helps externalize biases, building a data-driven feedback loop for self-correction. It empowers you to master your reactions, moving beyond the wound of financial confidence towards genuine clarity. The emotional consequence of an unexamined financial life is often a cycle of impulsive decisions, followed by regret and a deepening sense of inadequacy. But consistent behavioral discipline, like a steady hand at the helm, builds decision-making autonomy and resilience. It's a quiet, daily practice that, over time, transforms reactive fear into proactive wisdom. It allows you to navigate with truth, rather than being tossed by every market ripple. Drawing from Daniel Kahneman's thinking, fast and slow we understand the interplay of our intuitive system 1 and our analytical system to thinking. System 1, fast and emotional, often whispers urgency and fear. System 2, slow and deliberate, requires effort but offers strategic clarity. The skill lies in recognizing when System 1 is attempting to override your better judgment and intentionally engaging System 2. This mental healing model allows you to pause, analyze, and override emotional impulses, fostering a profound inner mastery that is the true guarantee of long-term success. A deep unease, an investment inadequacy, often settles in when we feel adrift without a true anchor in the churning waters of the market. Many are told that market timing is either impossible or the only path to success, leading to a relentless chase of price movements. But this pursuit, this frantic dance with fleeting numbers without understanding intrinsic value, is a path to guaranteed underperformance, a journey where every step feels uncertain. Society often distorts the image of the independent, data-driven investor, reducing them to a mere stockpicker obsessed with daily fluctuations. This narrow view overshadows the true, profound skill, the rigorous assessment of a company's intrinsic value. This misdirection leaves many overwhelmed by an information deluge, without a clear framework for synthesis, struggling to discern the genuine underlying mechanisms from the market noise. To find your true north, we turn to the fundamental principles of strategic finance and value investing. This journey involves a three-step technique for discerning the genuine underlying mechanisms, the hidden truths. First, understand the business as if you were buying the entire entity. Second, meticulously estimate its intrinsic value using established models, such as discounted cash flow or asset-based valuation. This isn't about predicting tomorrow's headlines. It's about understanding what the business is truly worth today, based on its future earning power or tangible assets. The fatal mistake of those seeking actionable, rigorously data-backed financial strategies often lies in valuing a company based on fleeting market sentiment, a financial forecast written in sand on a windy beach. This ignores the fundamental economic reality. Instead, we must learn to identify and appreciate economic moats, the sustainable competitive advantages that protect a company's profits and, by extension, its intrinsic value. These moats are the bedrock, the quiet strength that allows a business to weather storms and grow its worth over time. Consider the early career of Warren Buffett, a master of this discipline. His unwavering focus was never on chasing fads or conventional wisdom, but on purchasing businesses well below their intrinsic worth. This relentless commitment to value, this patient waiting for the market to offer a bargain, reveals the profound discipline required for long-term wealth accumulation. It shows us that the real guarantee lies not in predicting the market, but in understanding value so deeply that you become immune to its madness. The persistent fear of financial loss often deepens when we misunderstand the true nature of risk. Many cling to the myth that diversification alone guarantees safety, scattering their seeds widely but without discernment. Yet, true safety, a profound sense of calm amidst market turbulence, emerges from a deeper principle: buying assets for significantly less than their intrinsic worth. This isn't just a tactic, it's a philosophy, a shield against the unforeseen. Overconfidence bias, often mistaken for decisive action, can lead investors down perilous paths. It whispers that our analysis is infallible, that we've seen all angles, preventing the robust due diligence that true wealth accumulation demands. This is an unconscious limiting belief, a subtle arrogance that blinds us to potential pitfalls, leaving us vulnerable to market reversals. It's a quiet sabotage of our own preparedness. To navigate this, we engage in a symbolic exercise, applying Benjamin Graham's profound margin of safety principle. This is not a frantic sprint to get rich quickly, but a steady, disciplined journey to stay rich slowly, to protect what has been painstakingly built. It acts as a probabilistic buffer, a cushion against our inevitable inevitable analytical errors and the market's inherent volatility. It's the quiet wisdom of leaving ample room for things to go wrong and still emerge whole. Informed decision-making often stalls when it encounters an unconfessed lack of transparent, data-backed frameworks for qualitative company analysis. How do we quantify the unquantifiable? We will provide a practical, data-driven framework for calculating and applying a margin of safety, not just to stocks, but across various investment types, including real estate and bonds. This framework transforms vague anxieties into concrete, actionable steps, moving beyond mere speculation to grounded valuation. Consider the stark lessons of the 2008 financial crisis, a period when systemic risks, largely overlooked by mainstream analysis, brought the global economy to its knees. Those who had meticulously applied a disciplined margin of safety, who had bought assets at truly distressed prices, not only survived but thrived. This wasn't luck, it was strategic preparedness. It transformed feeling inadequate or outmaneuvered into a profound sense of control, demonstrating that the margin of safety is not just a financial tool, but a manifesto for resilience, a testament to the power of truth over market hysteria. A quiet frustration often settles in, born from incomplete or superficial financial education, leading many to underestimate the profound, almost mystical power of time. We hear whispers of passive income, yet overlook the active discipline, the continuous effort required for true compounding to work its silent alchemy. It's not about doing nothing, it's about doing the right things consistently over decades, allowing the seeds you sow to truly blossom. Sometimes we fall victim to an anchoring bias, mistaking stubborn consistency for sound strategy. We cling to initial assumptions, even when no market data, like a gentle breeze shifting direction, suggests a strategic recalibration. This isn't prudence, it's often a mental fatigue from sifting through unreliable financial news, preventing the adaptive capital allocation necessary to truly harness compounding's power. It leaves us stagnant, rather than growing with the changing economic landscape. To master this art, we embrace a three-step technique rooted in the fundamental principles of strategic finance and value investing, focusing on capital allocation. First, understand the true, long-term earning power of your assets. Second, prioritize the reinvestment of those earnings, allowing profits to generate more profits. Third, be disciplined in strategically redeploying capital when opportunities arise, not out of panic, but out of a clear, data-driven understanding of value. This is how the genuine underlying mechanisms of wealth creation truly work, building sustainable growth one principled decision at a time. Our own neurochemistry can often hinder this empowered, data-driven decision-making. The immediate rush of dopamine from a quick win, the cortisol from challenging a deeply held belief, can subtly steer us towards short-term gratification, away from the patient, long-term strategic vision the compounding demands. It's a constant inner dialogue, a choice between the fleeting excitement of the now and the profound, enduring wealth of the future. Consider the indelible story of John Bogle and the rise of index investing. His journey reveals the true long-term impact of seemingly small financial habits consistently applied. He didn't promise speculative riches, he advocated for consistent, low-cost investment over decades, driven by an unwavering patience. This disciplined approach, often dismissed as boring, consistently outperformed the speculative chasing of fads, demonstrating that the guarantee of success lies not in complex maneuvers, but in the steadfast, quiet power of compounding truth. We began this journey seeking a guarantee, a quiet promise of success in the tumultuous world of finance. We've walked through the intricate pathways of market narratives, behavioral biases, intrinsic value, and the essential shield of a margin of safety. The one skill we sought is not a singular, magical formula, but a profound, intertwined tapestry of internal mastery. The courage of independent critical analysis, the steadfastness of behavioral discipline, the clarity of intrinsic value assessment, and the wisdom of applying a robust margin of safety. This is the unbreakable foundation, your blueprint for unshakable investment success. Warren Buffett, with his characteristic clarity, once observed, risk comes from not knowing what you're doing. This skill, this integrated mastery, doesn't eliminate risk entirely, for risk is inherent in life. Instead, it guarantees success by profoundly minimizing not knowing. It transforms the vague, gnawing fear of uncertainty into a landscape of calculated opportunity, where every decision is rooted in understanding, not speculation. It is the quiet confidence that comes from truly comprehending the genuine underlying mechanisms, the hidden truths. You are not merely an observer in this market. You are the independent, data-driven investor called to be a leader in your own wealth creation journey. No longer do you need to feel inadequate or outmaneuvered, swayed by every passing headline or guru's pronouncement. You possess the tools, the frameworks, and the contemplative mindset to dissect, unpack, and navigate with truth. This is the essence of financial independence, not just accumulating assets, but mastering the self that guides those assets. The time to begin is now, not with a grand, sweeping gesture, future, but with small, consistent acts of discipline. Start applying these frameworks to your own financial life. Cultivate enhanced financial literacy, sharpen your critical thinking skills, and build the quiet confidence to execute independent, informed investment decisions. This is the path to sustainable wealth accumulation, to true financial mastery. This is the path where your inner landscape aligns with your outer aspirations. What small, deliberate step will you take today to deepen your understanding and strengthen your resolve?